Well, back with India Market Open right here on NDTV. Profit, pull up the markets for a brief bit and just see what we're up to. So the Nifty in the session today started off about 0.4% higher, currently trading in or around the high point of the day. So good going really. And a clutch of stocks have done very well. Warren Beverage is the case in point, but a bunch of others too. The new listings, the pre-open rates as they've settled seem to suggest that the listings will be strong for DOMS in particular. Let's see if there is more in store. But good time to get in Vinay Jaising, MD of PMS at JM Financial Services, for his thoughts on what's happening currently in the markets and what's the way ahead. Vinay, been a while. Thanks so much for taking the time out. Neeraj here. Good morning.
Good morning, Neeraj.
What's the thought, Vinay? I mean, the markets seem to have caught not just the bears, but even the bulls by surprise. The question is, can this move or can this exuberance continue well into the earnings season, or is there a case and a valid case for there to be a pullback?
So let's break this question up into a technical case and let's break it up into an earnings momentum run case. So on the technical case, it makes a very good long-term story for India because number one, the FII ownership is at probably a 10-year low for India. It's up 17%. Say if you put maths for a $4 trillion market cap country, you're adding about 3% to go to the number of 20, if we believe 20 is where FIIs want to be there. And that's, somewhere close to $120 billion of inflows coming in. Come June, you have the JPEM index, so bond funds also would come in of about $20 to $25 billion. So I think post-election, you're going to see a lot of catch-up impact of inflows coming on FIIs, be it on the debt market or equity market. The last month itself saw, close to $5 billion of inflows come in, and the previous month was 2.5. So that's FII inflows. Now, if you look at SIP inflows, that's a solid $2 billion plus a month, and about 30% more comes in from pension funds. So there's a lot of inflows coming in, which India has never seen. So that's, the technical point tells you that, the market's looking robust. Any correction, you should look at buying. So that's step one. Step two, if I look at earnings momentum, as far as India is concerned, earlier the legs of earnings were coming only in the financial sector. That was 30% of the overall index, and that was growing, at a very, very impressive rate of about 30 to 35% post-COVID, because provisions, were getting cut down. So even if the loan book growth was 12 to 15%, you had a very strong growth at the profit level. But now what you're seeing is companies in the capex sector, companies in, I think every other space but energy and IT, which are probably going to go back to where they were growing earlier. Most of the other spaces, the earnings growth trajectory is a lot more higher. So you're looking at north of 15% growth for the next 2-3 years. And that number, I think, will keep on getting inched up. So earnings is going India's way. Technical analysis going India's way, but mind you, what's not going to go the global way is the geopolitical risk, I think, which is very high. And, one of the things we went very wrong last year, we felt the world would have a recession in 2023, but the GDP grew a lot more than expected. And the pain point of that, globally would come in the first half of this year, especially, till they don't cut down the interest rates, the high for long interest rate regime, which has already existed for the last 15 to 20 months, will start slowing down the global economy. And there is, I think, a tougher year for overall world GDP. As compared to 23-24 will be a much tougher year. So the overall global ambience in the first half especially may not be interesting. Second half, you'll see interest rates come down and people will be smiling again. Sorry, but long answer, for your question.
Well, that's okay, Vinay. And it's good to get these long answers as well. The question though is around earnings, and Vinay, I heard your point. The thing is that it's almost a trending year, yes, and therefore there is a validity to an argument that some people are making that earnings might surprise in quarter 3, arguably quarter 4 as well. But we know the world growth is slowing down. At that point of time, are we seeing at FY25 being a year wherein earnings might hold a case for disappointment because the external facing sectors will have a real issue when it comes to earnings delivery?
Absolutely. So if I was you, and that's what we're doing for our fund, and same thing we're telling investors: look a lot more domestic, look a lot less global, look a lot more on making India stories, which are probably giving way for what was coming into the rest of the country from the rest of the world. So let's say defense, if you are buying from the rest of the world earlier, today we are producing it internally, so that's a make in India story. The defense budgets, not just in India, globally, are going up. So look a lot at spaces where you depend internally for your demand. If you're looking at capex, that's a function of the Indian budget. Corporates have still to tick the box. So I agree with you totally. Domestic story will just increase in the year fiscal 25 compared to the year fiscal 24 for equity investments, for you to get a healthy equity investment return. Having said that, what's also happening, and I'm just taking case in point, let's say for the IT sector, which depends a lot as far as US is concerned, and there could be a global slowdown in the first half of the year. But think of it this way, right? The IT sector, you break it up again into two baskets. First basket is the large IT companies, which depend on virtually the US economy, and the second is ER&D companies, which are pseudo manufacturing and pseudo R&D companies. They're small. The way these companies, and there are many good quality companies, be it Cyient, be it Access CAD, be it Tata Technology, all these names, are getting orders from the rest of the world in the space they are good in, which is increasing, be it in airlines, be it in defense. So you could see even global facing sectors as one-offs doing really well, purely because India is becoming a China plus one play. My concern really, Neeraj, is more so on if there is a global slowdown in the first year half. Would there be outflows before elections, and then once interest rates come down, isn't 2024 going to be a tale of two stories? The first quarter wherein you'll see pain, and then the next 9 months wherein as interest rates go down, every economist and strategist will remind you when interest goes down, it's good time to increase the intrinsic value of companies, and this is where the market should go up. So, you'll see two paths, I think, in next year.
Vinay, stay on with us. Vinay Jaising here weighing in on where the markets are headed. But meanwhile, I just want to quickly show you two pictures on your screens right now. These are two new listings which we're going to be seeing in just about 30 seconds from now. One is DOMS Industries, the other is India Shelter Finance Corp. And both looking like, as of now, that they might give their investors or whoever got those allotments a decent listing pop. Now, this has definitely been the flavor of the season, or I would say the flavor of the year, and I'm going to come in just a bit when we see how those companies list. We're going to come and just ask Vinay his views, and I mean $1,400 on DOMS. It was a 790 rupee issue price. You're seeing on India Shelter Finance Corp as well, a very good pop actually. You're seeing a 16-17% listing gain, and that will perhaps pare down. But it's telling you the nature of the way money is being raised in this market, and those who get in on allotment are also being rewarded. How it settles remains to be seen. I was just taking a look at Flair Writing because it was a previous issue and also in the same space as DOMS Stationery Maker, and that's not doing too badly as well compared to listing prices. So we'll keep tracking those stories. But Vinay, hi, Tamanna here, and I just wanted to get your sense of what is happening in the primary market. Now, those who are slightly skeptical might say that in this rush for money to find a residence, you might have kind of fundraising which doesn't deserve the attention it's getting, whether it's IPOs or QIPs. Do you think that concern is there, or do you think that you're seeing the right value right now for solid companies?
So, the statement is price is always king, that rules the roster. Having said that, even at the price at which IPO is coming, as you can see in the screen which you showed, the stocks are moving a lot higher in the shorter term. So we got to take case in point of companies. We can't make a generic statement. Having said that, let's look at a couple of names, which have come out in the shorter term. Be it companies like Concord Biotech, be it companies like Blue Jet. What you've seen is quality of IPOs which are coming in, or even Tata Technology, the quality of IPOs coming in are far better quality as far as balance sheet is concerned, as far as the earnings trajectory is concerned, than what was earlier. Both the breadth and depth of the market are very impressive for the new IPOs coming in. And that, I think, is giving a lot of feel-good factor to an investor. As against, you're coming to the market because you desperately need to change your debt burden, your costs of capital are too high, and you're using equity in a wrong way in the shorter term to replace that. What you're seeing really is nice names, good earnings trajectory. So focus really on not what's coming out or what you're buying based on, what you're hearing, but focus on, going back to your balance sheets, because this is the time for valuations being, clearly much higher than what one would have expected if you were starting the year. So focus on quality balance sheets, focus on earnings, high return on capital employed, and you'll get a lot of names. But as bottom-up ideas, you can't make a generic comment, unfortunately.
Enough. So which is why let's get to the specifics on how you pick those bottom-up ideas and what is looking interesting right now. It becomes a tougher and tougher call, doesn't it, Vinay? With that much excitement and funds flowing in, and then the responsibility or the expectations of generating those kind of returns. So is there any space that you're particularly seeing with that kind of an upside potential?
Sure. Let's break the space up into three. The first space is CapEx, the second space is Make in India, and the third space is consumption. I would have normally gone the other way around, but because, the time of the market is such that people are questioning mid and small cap ideas a lot, and should we be invested, should we go out? That's the question which is in everyone's minds, because if you look at the year 2023, the small and mid cap space is up almost 40%. It's like the Nasdaq, and these are the two best performing spaces for any investor in the world. So when we look at the CapEx space, what are we getting a feel good from? The first is the government increasing the CapEx, be it in rail, be it in road, be it in defense, be it in water treatment. Now, if you come to this space and we're talking about increased CapEx, which is 5 to 6 times in the last 10 years, some of them, like in the water treatment part, have CapEx increased as much as 7 to 8 times. Some of them in the defense field have CapEx increased in 9 to 10 times. Road is 12 times. You know how much time it takes you to reach, from your home to your office. You can see the amount of construction work which is going on, and that's all over India. So that space is something which we are excited about. But here, you have those companies which are at very, very high valuations, which is 50, 60, 70. And then, though their ROCEs are pretty impressive, they may be a sourcing hub of India. Last year, these were a place. Now what we're looking at a lot more are companies which are doing good on technology. They have a ROCE of maybe 15%, but their earnings growth trajectory is 25 to 30%. What's important is their balance sheet is either net cash or rock solid, far better. Their cash conversion ratios are positive, as against them just keeping on increasing their overall balance sheet size, because they need to be taking loans for the revenues which they are getting in. Those kind of companies, I think, would do a lot better in the next years, because CapEx is one thing which India will keep on increasing. Remember, we are the most populous country in the world, and being the most populous nation in the world, you need to have workforce coming in, and I think that's the single biggest agenda for this government and any government to take care of. So I think tick the box on CapEx. You've not seen corporate CapEx take up, so that gives us even more excitement, because today all the load or the burden of CapEx is being borne by the Indian government. As you start seeing CapEx take up a lot more, you will start seeing a lot more visibility of shorter term projects also come up, and you will see more ideas come up. So that's the first story, CapEx. The second, Make in India, and going back to Neeraj's question, as I did say, look domestic, but where you have an edge, be it in the chemical field, be it in the production field, contract manufacturing field, be it in pharmaceuticals or in products like defense, where India is probably replacing China, where it has the DNA to do so. I think that's a field we are looking at in a very, very big way. The third field is, the erstwhile finance and consumption put together, be it in drinks or be it in the QSR chain, or be it, purely in, how, today with real estate being the need of the hour for people and rates not having moved up so much, and interest rates in India, 5 to 10 years ago were much higher than what today. We won't be surprised if you start seeing, volume growth in the real estate market happen, especially for affordable housing. So it's good to look at, the associate spaces linked up to affordable housing, be it finance companies or be it purely, companies which are going to give products to these finance companies, the building material companies. So there's a big space I think you can look at, but it's all about bottom-up picking. Let's not be very general. That's a comment we want to leave behind as well.
Vinay, I don't know how specific you can get, but let's talk about the last theme that you mentioned, real estate, right? Now, how are you going about choosing which sphere to bet on, whether it's ancillaries or pure play real estate companies, and within that too, which companies, if at all, come to mind, because there are pan-India players, there are South India players who are probably doing much better on the volume front, but it's not that volumes are missing in MMR or NCR region either.
So I think we would look at more ancillary companies as compared to real estate companies as of now. That doesn't mean that in 3 months we would change and do that, because this is a space we are looking at based on the pricing on a regular basis. When we're talking about ancillary companies, it's there are many sockets which we are looking at. There were cement companies which we are looking at in the small cap space, because there, A, the cement demand is increasing. B, the EBITDA per ton, courtesy, price increase is improving. So even if there were coal price hikes which are happening, you're being able to pass it on to the end consumer. We're looking at building construction and pipeline spaces. So all these spaces we are looking at in a reasonably big way, the FMEG space. Having said that, currently we don't have a lot of this in our portfolio. These are things we are looking at as we talk, just to be fair.
Okay, so you're comfortable buying some of these at the current valuations, because almost everything which is real estate ancillary has had a really good run in the last 18 months.
So, which is why Neeraj, I said we don't have it today, much in our portfolio. What we have, if there are corrections, we'll look at it. This is a space we're looking at a lot more. The other three spaces which we mentioned, be it in defense, be it in capex, be it in the consumption, we are buying immediately. Again with a function of, are they at their weighted average P of the last 5 years, or more importantly, there could be a case in point of companies, let's say in the cap goods sector, where their peers are trading at 40, 50, 60 times, but let's say companies like Kirloskar Oil, Vatek, which are sub 15, 16 times multiples. We're focused on those names because there we've got a valuation feel good factor. That's very crucial for us, Neeraj. At this environment, to just get carried away with earnings and not look at valuation is not our style.
Vinay, I wanted to get your take on a couple of spots of exuberance, perhaps. Maybe in the last couple of days, Indian IT defying expectations as we speak in terms of performance, and yes, from a relatively short-term view. Wanted to know if you have a take there. The banking space, and the third, if I may add, is the whole renewables play. Like you said, in the point of capex, or in the context of capex, policy push very clearly on building, policy push also very clearly on building green. So, if you have a take on these three spaces.
So absolutely, so let's first go to IT. The way we look at IT is you break down IT into the yesteryear's IT, the big large cap companies which are a lot focused on, obviously digitization, AI, but they depend a lot more on the global mandate which they get. And if there is a global slowdown coming in the next 3 months, yes, interest rates will fall, and these stocks have moved up. We're keeping them, but we are avoiding them currently. We were underweight the IT sector for most of last year. We're actually inching up in the IT sector, but what we are buying really is the mid-cap space. And here's where the ER&D story I was trying to tell you earlier comes into place. If it's companies which are, in the data analytical space like Persistent, or if they're companies which are in the ER&D space like Cyient and AccessCAD, where you have the advantage of one, airlines, going crazy because of the demand which they're getting, and, seating arrangements being required for them. And these are 5-year projects. Two, you're seeing the EV story. Earlier you had just a KPIT, but now you're seeing orders go to, even companies like Cyient and AccessCAD. What's also interesting is 3, you're seeing a lot of defense stories emanate in terms of software coming in the IT space. So we are a lot more mid-cap focused in the IT space, but we are inching up to being equal weight to the IT sector, but buying the new generation IT names, if I may use that word, as compared to the older generation IT names. That's your first question. Moving to the second question on banks. The way we look at the financial space is we break it up into the lending space and we break it up into the non-lending space. In the lending space, we are very excited. Our financial analysts as well as economists, Pooja and Anirudh, are very excited on the loan growth of the country. The 20% number may be a little bit of a misnomer because you've seen HDFC Limited come in. So if you look at net of HDFC Limited, you're seeing 17-18% long-term loan book growth. Even if that were to go to 16%, the banking sector has never had such robust balance sheets. You've not seen such high quality capital adequacy ratios, but you've also not seen a retail growth of as much as 30% year and month on month. And you're seeing that number just get repeated, and everybody tells us be careful because the NPS could be the next place to focus on, could be with retail NPS. The CapEx cycle is still to come out. So there's a big story coming in there. So that space, we have lots of interesting ideas, in the overall space, but MFI space also is looking very, very appealing. Just to name one of them is Fusion, something which we are looking at in a big way because one of the few companies which warned us that there is a lot of rain coming up in North India, because of which their loan book growth may not be 30 to 35%, maybe a notch lower at 20 to 25%. They raise capital, their capital adequacy ratio is 25%, and they have a ROE of as much as 5%. So lots of good ideas, but again, bottom up is really the way to go. So these are the two questions. Could you just get me back to your third question?
Renewables, and completely my fault for bunching up so many questions together, Vinay. Apologies for that. The renewables green push. So whether it is companies financing them, companies on the tech side of it, or then the final product, all of them seem to be seeing a lot of enthusiasm. I wanted to know if you've been able to sift what is real and what's not.
So, what we are looking at the renewable space clearly is the finance space. And again, we are working on that. We've not nibbled into it, but, we are looking at the finance space. And here in the renewable space, you have two stories, right? One is in the finance space, what are you going to get? What are you paying for in terms of price to book? Are you paying 1.5 times or 3? We're kind of avoiding the 3 times companies and focusing a lot on the 1.5 times price to book companies. The second part of it is, again, I'm going back to the CapEx related to the renewable spaces, not the people who are purely doing the renewable space, but the people who are doing the EPC contract. Are they companies whose balance sheets have changed overnight or in the last month or 2 months? Are these companies wherein what you're seeing is all of a sudden they're net cash, or they will become net cash this month? And the biggest problem for the EPC companies historically was balance sheet, and balance sheet, right? These were the 3 big problems because they didn't know how to invest, how to get, loans at cheaper rates. There were problems of them on the working capital and the cash cycle. So the same story which we used earlier on the CapEx cycle, we are using on the renewable space. And I agree with you. Some of them have really moved up, but we are really eyeing the utility space, pure yesteryear utility space, and more importantly, a couple of the EPC names where we think the net debt is vanished all of a second, and the earnings growth trajectory is super crazy, because what is the government will increase capex in this space. That a couple of gigawatts per year is a done deal for execution, be it in India or be it in the rest of the world. So the companies which have the bandwidth to do that are where we are focused on.
Absolutely. Thank you so much, Vinay Jaising. Absolute pleasure speaking with you today on NDTV Profit. We'll take a very short break, but the excitement continues because on the other side, we have Maruti Suzuki's Shashank Srivastav to talk about the company's road ahead.